Hello, this is Graham Hume from SOFTRAX. We're just giving some arrivals time to get in and get settled, and we will start up in about a minute. Thank you. Hi, welcome. Thank you for joining today's webinar, where we will be talking about SEC comment letters and companies' responses. This is part 4 of our ASC 606 webinar series, and we're happy to have you all join today. Starting out here, so just today's agenda. We'll do quick intros and background on SOFTRAX and Effectus Group. We have Effectus Group and Matt Sved join us today, and he's been on prior webinars. And if you listened before, you know the value that he brings in terms of just real world ASC 606 hands-on experience, and we will continue that today. The context for today's webinar and what we really want to focus on is the natural progression of what we covered leading up to December, in August, September, October, and now obviously in December. So we started with reviewing companies' ASC 606 disclosures and their SEC filings. We then talked about SEC comment letters that came to those companies. And today we're going to match the company's responses to those SEC comment letters up with what we've covered so that we can see the holistic viewpoint of filing through the point at which a company has to respond to the SEC specific to 606. And so that's really the focus of today's webinar. And so from a housekeeping standpoint, similar to webinars you've likely been on in the past, questions can be submitted through the GoToWebinars question box. And any questions that come in, we will certainly do our best to answer as time permits at the end of the webinar. Otherwise, we will follow up with you directly, whether it's Matt and or I will follow up you directly via email, or if a call is most applicable to do that, we will do so. And this is a CPE eligible webinar, so 1 CPE credit will be given for attendees that stay on for at least 50 minutes and answer the 4 polling questions that we will run through today. All right, so just in terms of meeting today's presenters, I will let Matt, we have a slide in a moment where Matt will introduce himself and Effectus Group for those of you that have not listened to it before. But my name is Graham Hume, and I'm the Vice President of Product Management here at SOFTRAX. Just quickly, I own the product direction. I own everything is laser focused on automating revenue recognition, compliance, and meeting 606 requirements. And so I own all of that. That's the quick bio. In terms of who SOFTRAX is, what we do, etc., we're a company based in Boston, Massachusetts. And we're a part of a company called AFS Technologies. That's our parent company. The net of it is we've done hundreds of deployments of revenue management solutions and pioneered the automation of standalone and ERP embedded revenue management solution. And so we have offices, obviously, both we and our parent company throughout the U.S. and globally. Our clients, it's a pretty well-rounded list. You can see up here. I won't read them off all. What I would say is they vary in terms of size, whether they're public or private, and verticals. The common thread with all of them is that they've had complex revenue recognition needs, complex order-to-cash and order-to-revenue needs, and they've chosen us to help them solve those needs in an automated fashion. So let's dive in here. Matt, I'll turn it over to you so you can discuss Effectus Group and just do a quick intro.
Thank you so much, and thank you all for attending this webinar. I think it'll be a great webinar and very informative from an ASC 606 implementation perspective. I'm Matt Savetich. I'm with Effectus Group. For those of you that don't know Effectus Group, we are a technical accounting firm out of Silicon Valley. Everyone at the firm is former Big Four. And we've completed this year, I estimate, well over 100 ASC 606 implementations, both in terms of technical accounting, as well as some implementations on the IT side. So as we walk through these SEC slides, I'll be providing the color commentary. My background is former KPMG. I was also the managing partner at an international accounting firm, so I have some international accounting experience, which is helpful when looking at ASC 606 because a big part of the literature was written from an international lens or standpoint. Thank you.
Thank you, Matt. So let's start out with our first CPE question, and then we're going to get right into our content, our polling question, excuse me. So let's get into it. So I'm going to share this, and you should see it on your screen. The first question is, we take a look at it. How many spreadsheets does your company use to manage revenue recognition requirements under 606? And then give you about 10 to 15 more seconds to answer. Okay. All right, I'm going to close that. Let me share the results here. So we can see here in our responses, if we boil it up, we've got one and none at the top and bottom, but in the middle, let's just say it's multiple, right? And so this aligns with what we've seen, and obviously Matt, I'll certainly want your input, but we've seen, because we deal with companies that are trying to migrate off spreadsheets, it's not uncommon that we would obviously hear that from them. But the numbers here are interesting in terms of how many are needed to manage through the revenue side. Matt, any comments related to this?
Yeah, so I would say a majority of our clients that we do the ASC 606 implementations for are using this opportunity to upgrade their IT systems. So typically they're coming from Excel and then going into one of the larger software programs. I would say for contracts that are open as of the adoption date, it's a mixed bag on whether or not companies are inputting those contracts into the new accounting system or if they're keeping them in Excel, given the fact that the prior or historical transactions the company may not want to have in a product that's just being implemented.
Thank you, Matt. All good points. Let's close this out and get back to our content here. So let's start our first example here. So the first example, we covered this a bit in our prior webinars, but the first three examples really get to fundamental questions from the SEC about companies' adherence to 606. So we'll move slightly quicker on these than when we get into some meatier topics, so to speak. But let's start out with this one. And basically, the question is along the lines of the comment from the SEC is your disclosures on pages 13 and 15 suggest that you did not adopt 606 as of January 1st. And so if it's true, please refer to 606.10.65.1a. Tell us why you did not adopt. And then, and I'm paraphrasing, if you did adopt, provide the disclosures required by the guidance. And so, quick input from our end, you can see the company's response. They obviously, they indicate they amended their quarterly report to indicate that they did adopt. So to an extent, they backtracked a bit there, if you want to use that term. Matt, one thing that I know when we were preparing for this that caught our eye, I don't want to speak for you, but it caught my eye, and something I'd want to get your input on is the note says, after consultation with the company's independent registered public accounting firm, the company has determined that the disclosure required by 606 is not material to its business. And then it lists out the bullets below, which touch on, different aspects of the company's model in terms of, how it disaggregates revenue, its pricing, how it recognizes revenue and satisfies the performance obligations. But I haven't seen that, and we've done a lot of work looking through filings, for the past almost 2 years. I haven't seen a company, it's not frequent, I'm not saying it hasn't happened, where using the reference to the disclosure requirements of 606 are not material to its business. So is that something that, that you've encountered in the field, or is it something where when you engage with your clients or prospects where it's something they have to be talked into? Just what's your experience there?
Yeah, so a couple of thoughts on this. Unless a company is, for example, in lease accounting or some other standard of accounting for revenue, the companies need to adopt ASC 606. Now, at the same time, they need to conclude if they do whether or not it is material to the company. And there's several different ways of looking at materiality. Materiality to the financial statements, materiality to the business. I think it's important that companies take a step back and understand how they see materiality internally, kind of irrespective of the auditors, and then pair that up later on with the way the auditors are thinking about materiality to make sure that it's at least similar, so you don't get inconsistent accounting conclusions. In this case, it looks like it was such an immaterial amount that the company really didn't disclose some of these additional details. I would just say it's a good idea that at least the companies make an affirmative statement in their initial filing if something is material or not. And there's plenty of examples out there for public companies with immaterial like revenue. How do you want to say it? Like immaterial revenue as it relates to ASC 606, right? So they may have a combination of material revenue with leases, but immaterial revenue with regard to ASC 606. So it's just important to delineate that point and to describe it in some detail so that you don't get the SEC comment letter.
Matt, all good points. I mean, I think we'll hit on some of those again in the next one or two examples. So if we transition to example 2, I think, in this case, the comment is similar. It says, we note your disclosure, which states you adopted 606 in the first quarter of 2018, and the adoption did not result in significant changes to the timing or nature of your revenue recognition. We also note that the disclosure of the disaggregation of revenue from contracts with customers in note 4. Please tell us the considerations of the other disclosures set forth, and it talks about what those other disclosures would be for 606.10.50, and then has a few reminders at the end of the comment. And so, the takeaway on this one is obviously the company's response says, okay, your comment is noted. It says how in future filings it will enhance disclosures to explicitly address the considerations of other disclosures set forth in the 606, and it provides a 3-paragraph, as you can see here on the screen, a 3-paragraph description of what the updated filing would say. I think what's interesting here is, from our standpoint, the comment effectively questions the company on, all right, it's almost like, Matt, and I'm not speaking for you, but from our standpoint, it's almost like they took steps to evaluate those disclosures, but using a term that we've discussed in prior webinars, and I don't know if you agree, but it's almost like they only told part of their story, meaning they expressed one part of the disclosure requirements, but left another, 3 or 4 untouched, and effectively that opened up the SEC's question based on the 3-paragraph response they have here, where they're running through, key areas related to, pricing, how they sell the products, and then it gets into variable consideration, time value of money. It really, is much more comprehensive. Is your view in alignment just with ours in that, they did the work, but they didn't tell the whole story, potentially in this case, and that their updated filings certainly could do that for them?
Yeah, I would say this, this is one of the most important concepts that's come out of ASC 606 is the company needing to tell their stories. Because in the past, a lot of the filings, and this is one of the reasons that 606 it changes the disclosure requirements, a lot of the filings were pretty consistent. So said another way, almost all the companies that were in certain business sectors had some canned language that was put in there. And so it really didn't describe the specific facts and circumstances of the company. In this case, the company's response, went into some detail about the different aspects of their business and how the timing didn't change. And what I would say related to this is sometimes under 606, it takes just as much work to figure out how to get to the same revenue recognition timing method under 606 as what you may have had under 605. So I think what the SEC is getting at is even if the timing didn't really change, tell us why it didn't change. Tell us how you walk through those different aspects of 606 in detail so that we can understand that, not only why there was no impact, but also so that we could read into areas that could potentially be impactful that maybe the company isn't thinking about.
Yeah, Matt, it's the classic, and I, at the risk of being too personal here, I'd say it's we have a middle schooler at home, and it's not enough to just fill out the math problem. She has to go through an exercise to show all the steps that led to it. And when I looked at that recently, and I don't know if it's good or bad that I'm thinking about 606 when I'm with my child, helping them with homework, but that's what it made me think of, is that it's not enough just to show the answer. You have to show how you got there. So I think on that front, I think number 3 is a similar one, Matt, in the sense of, similar comment, please tell us how you consider the requirements of 606, 105013 through 5015. And then this one touches on, disclosing information about remaining performance obligations or application of optional exemptions. I think where this gets, and I'm not saying that first part isn't interesting, but where it becomes more targeted is that the SEC clearly noted here, you can see, we note that your Form 10-K for period ended December 31st, 2017, you state that you sell product to your largest customer representing 22% of total sales. Under a long-term contract, you further state that your other customers, you typically sell them under contracts with 1 to 2 year terms. And so that duality of long-term versus short-term contracts comes up, and then the company's response is I call it fairly robust in that you'll see in a moment, but effectively they modify their filing, or they will modify upcoming filings to speak of control. As you can see here, those areas that are bolded and underlined are the new sections that they're representing. They will present in future filings. And then this particular piece, you can see this is all net new. And without reading this entire response and potentially losing people, I can see it in the console here. If we do that, we might. But I would say this, is that, Matt, one of the things that I took away from this is when you read the first sentence, it starts to get into something. It says, the sales of our products to customers are made under a purchase order and in certain cases in accordance with the terms of a master services agreement. And then it starts to talk about, purchase order and master service agreements interplay in their world and how that all leads into revenue recognition. And so, the takeaway, at least one of the biggest takeaways, and I'll let you speak to the technical accounting side of it, is that, during the summer, was reading a number of articles where the SEC was making counterpoints to complaints from companies about the cost and the level of effort it takes to adhere to 606. And their point was, well, you have to look beyond your viewpoint and look at it from the benefits that the readers of the financial statements and of a company's results are getting by more transparent and more robust filings. And this would be an example where when you compare the initial submission in their filing to what you're seeing underlined and bolded on the screen, this level of transparency on their business model and how they handle their contract / order to revenue process wouldn't have been there potentially in the pre-606 days. And so this would be an example that would align with the SEC's input that I saw at a conference in the summer where they were advocating for the benefits of 606. From your standpoint, Matt, what have you heard, or what are your thoughts on those topics?
The way I read this is it's really important to look for discorroborating evidence. It's an auditor term, but what happens when these documents get created is there's so many individuals that are writing in different sentences into the document in different locations. It's important to have a good read-through of the document to look for discorroborating evidence, like evidence that shows, for example, that may say that you have multiple year contracts, and then another section say you only have 1 year contracts, right? On top of that, the importance of defining what your contract is very important under 606. And it may seem obvious, but like in this instance, there may be an MSA, but the actual contract related to that's driving the revenue recognition could be the purchase order, and that purchase order, could be for a year or less, right? And then you have a long-term MSA. So it's important to go through those details both internally, document that in your ASC 606 adoption memos, as well as disclose what you believe you need to publicly, always benchmarking yourself against your competition. The goal is always to comply with 606 and to report at the sufficient level of granularization, but no more granularized than maybe what your competitors are, unless there's a specific aspect of your business model in play that would require that additional disclosure.
Thank you, Matt. That's a very good point, and that was something I came across recently that I hadn't seen frequently in year one, but it has been coming up more as companies go into year two and mature their 606 processes, is that as they mature, to be careful, to your point, about not exposing so much of your business that it puts you at a competitive disadvantage. That point was, your point spot on there, Matt. All right, we have our second polling question, and so I'm going to bring that up before we move on here. So let me launch that for you here. And so the second polling question is, what is or was your company's biggest concern about moving from spreadsheets to an automated solution to support 606? And so I'll give you everyone another 10 to 15 seconds. And let me close that up here. Just seeing people voting here. Okay, we've got some last minute voters. All right, closing it out. Let's take a look at the results here. And so, okay. Interesting that we have that level of, so we've got, I'm taking a look, I'm sorry I paused there, but it was interesting. Loss of flexibility, control, and then the ASC 606 pain not material enough to justify. Interesting. Matt, when you look at these, do these align with what maybe you encounter initially when you're effective and you engage with clients, and then does that viewpoint potentially change as you're working with them over time? I know those are somewhat leading questions, but just wanted to get your take on these results. I'm sorry, did I lose you, Matt?
Sorry, I lost you for a second there, but with these results are interesting to me. From the ASC 606 pain not being material enough to justify the automation costs, I'm actually not seeing that so much. Most of the companies that we're seeing, they may initially have thought that there isn't going to be a big difference, but when they actually get into the details and see how the mechanics work and how 606 requires them to calculate the revenue, even if they're coming to the same answer, the mechanics are different. And because of that, companies are pushing towards an automated solution, or at least a partially automated solution. I do agree that sometimes the solutions can be a little bit complex and difficult to implement. And also, to some extent, there's less flexibility, although these systems have improved dramatically over the past few years.
Thank you. I would agree with that. I mean, it's what we see when we engage with our. Okay. All right. Let's moving on. Let's get back to business here on these examples. So, example 4 here. This is a pretty short one, Matt, but I think it's pretty direct. So the SEC's comment was effectively, please, directly, it was describe to us the type of engagements that result in professional services revenue being recognized upon completion of contract. And so, the company's response effectively basically says, well, we respectfully advise the staff that substantially all of the company's contracts for professional services are based on time and materials delivery. And then it makes the point that there's an immaterial amount of professional service revenue that is recognized upon completion based on hours delivered. So it talks about how it will revise the disclosure. But I think the interesting question that pops into my mind is they answered the question, but they're saying, and I don't know, Matt, what your standpoint is on this, but they're still acknowledging there's a certain amount, albeit immaterial, of professional services revenue that is based on the completed contract. The answer doesn't necessarily provide a lot of detail there, and the SEC may not be as interested if it's immaterial, but it was interesting that the response lacked that, at least that, addressing that question head on, and then also that the initial comment even referenced it if it's so material to the business. So, from our standpoint, the completed contract method could be a red flag if the SEC sees it. You might get an automatic question if it's not adequately explained as to why that was selected and how it's used for RevRec. Matt, is that something you've encountered when you've dealt with companies in terms of the completed contract method, companies, trying to identify how they change or if they need to change from that, and then how they present it when they in their filings?
Yeah, a couple things may have happened here where some language may have been brought forward from a prior filing. Just to remind everyone, under ASC 606, completed contract method is somewhat of a last resort. So it's not expected that companies would typically be under a completed contract method. So if this is included in a disclosure, we would expect that disclosure to be very robust in explaining why this company, for example, in particular, is the exception, right? Anytime a company is going to take the position, we're going to talk about this later on some other slides, that they're the exception for certain types of accounting, the SEC is likely going to have a comment to that exception if it's not robustly disclosed.
Thank you, Matt. Let's go to 5 here. So as we progress through these examples, we're getting a little deeper into the guidance and into hotter topics from our standpoint. And so one of those topics is the topic of upfront fees. So this particular comment points out to the company, you disclose that when upfront fees provide the customer with a material right to renew, those fees must be deferred and amortized into revenue over the typical contract term. Please clarify what you mean by typical contract term and whether this includes anticipated customer renewals. So a few things to unpack here. The company's response, I think from a perspective, at least from our perspective, it was robust in terms of explaining how it handled the upfront fees. And I thought it was notable in that, the company goes and it says basically, we often assess upfront fees to new customers, including fees related to the installation of equipment and the undertaking of activities necessary to perform under the contract. Inherent in the upfront fees we charge to our customers is the right to renew without the customer having to incur additional setup charges or fees, which we view as a material right. As a material right under 606.10.52.42, we do consider renewal periods in establishing the period over which to amortize these fees into revenue. and then that we refer to this period as a typical contract term. And then below they have a pretty, it's succinct, but I think it gets to the point of how they would update future filings. And so in this case, I think there were two things that caught the SEC's eye, Matt, in the sense of, the company used, for lack of a better term, company-specific terminology without necessarily defining what that terminology means in terms of a typical contract term. So that was one potential flag. And then obviously referencing the fact that, there are upfront fees included. I know in our preparations for this webinar, upfront fees, not putting words in your mouth, but that is a topic, at least on our end, and I think for yours, where it comes up, it's been coming up a lot in terms of how these need to be handled relative to how people did it pre-606 versus under 606. What have your experiences been with how companies have handled the upfront fee requirements?
Yeah, so with the upfront fees, it's actually fairly similar under 605, the accounting, and also the area of the importance of defining what the upfront fee is, because sometimes upfront fees need to be recognized over a contract term or potentially a longer term than the contract. So it's important that companies really take a hard look at anything that they're describing as upfront fees. In addition, with regard to contract terms, this is an area where under ASC 605 wasn't as big of an area of focus, but under 606 is huge. So for example, if companies include termination for convenience provisions in their contracts, let's say normally what would have been considered an annual contract, but company has a 30-day termination for convenience provision, essentially what the company has now entered into is 12 monthly contracts and not one contract. So the pivot from 605 to 606 as it relates to contract term is fairly significant, and the company will need to clearly document what it believes its contract terms are and why.
Yeah, I think from our standpoint, just from an automation standpoint, the upfront fees have represented a challenge where automation has helped folks greatly because of the points that you just hit on, Matt, and the fact that when they get into scenarios where, let's say the term of benefit, they're looking at, and they evaluate it and it needs to change, and they need to do math changes on a frequent basis, and looking at data sets to do that. That's where we've seen automation help greatly. Certainly has been done and can be done in spreadsheets, but it's a heavier footprint there. And so all gels with what we're hearing and seeing. Okay. Let us have our third polling question here. And so I'm going to bring it up here and launch it. It is, did your company do revenue allocations prior to 606, or is this a new requirement for your company? And so this is, there's only two answers here, so it makes it quicker to respond. I'll give you another 5 to 10 seconds. All right, close that out. Let me share the results. So you can see here that obviously vast majority, folks have done allocations prior to 606, but we do have a segment of the audience here that their companies had not. And this lines up with what we're seeing, and Matt, I'd love to hear your input in terms of, in the 606, because obviously it applies across industries, across verticals. It's for everyone now, rather than having industry-specific guidance. Concepts such as allocation, it wasn't something that certain industries had to deal with as, let's say, deeply or at all as let's say the technology industry, what have you. So before 606, and so we've seen that as a driver as well, where that need, that level of complexity, has led to automation versus doing it all on spreadsheets. But in terms of what you've seen, Matt, are you getting questions about allocations in terms of, and are those questions, baseline ones, like, what is it, how do I do it, or are you dealing with companies that are more mature and have done allocations in the past, and it's more about how to do it correctly under 606.
Yeah, I would say it's a little bit different than that. So what we've been seeing is, the nomenclature under 605 is multiple elements in a contract. Under 606, it's multiple performance obligations. What we're seeing is a number of companies may have had one or two elements in a contract under ASC 605, but under 606, they may have three or four. So 3 or 4 performance obligations. So it's really been a mixed bag on what's driving those companies who may have not have done revenue allocation in the past and may be doing it now, or those companies that only had 1 or 2 elements in the past that now have multiple performance obligations. What's really important here is to understand what really the time requirement's going to be in order to do those allocations and how to do them most accurately. Excel spreadsheets are very prone to error, as we all know. So some type of revenue automation solution may be a better option, particularly given the fact that the new standard has some of these complexities that I mentioned, which may result in 1 or 2 a multiple step allocation being required. So different things to think about before deciding what type of system to go with, or deciding to just use Excel.
Thank you, Matt. You hit on a great point there, and we've seen it in for the public companies that we've worked with in year one, is that getting to the point of the allocation is in some cases the challenge in terms of for companies, in the sense that having reliable source system data so that they can come up with accurate standalone selling prices, or determine that, whether they can or cannot come up with standalone selling prices. That has been a challenge from a standpoint of, if all that data is in a separate system or a separate spreadsheet, what have you, getting that all put into a central, whether you want to call it a database or system, and then having visibility into it so that they can do an analysis on a recurring basis to come up with accurate SSPs. That has been the challenge that we've seen frequently before folks have even been able to cross the allocation bridge. And so it is something that we've seen over time, that we've seen over year one, and people are obviously getting better at that, but it was an unexpected challenge for some folks based on our experiences. I can't speak to what you saw, Matt, but that definitely was something we've encountered.
Yeah, I agree. That's similar to what we encountered as well.
Okay. All right. Let's continue here. So moving on to example 6, okay? Again, getting deeper into the weeds, so to speak. This one caught our eye because it was an interesting comment with respect to the SEC identifying different types of contracts that a company offers, and then asking about a particular type of contract in terms of how they handle it, how they determine performance obligations in it, and et cetera. So the comment here is effectively, we note your disclosure on page 10 that in your commercial spare parts contracts, you allocate the transaction price to each distinct performance obligation. Please tell us the nature of each performance obligation in these arrangements. In addition, tell us how you determine that spare parts were not optional. And please refer, and it talks about the area of the guidance, 606.10.25.1. And so the answer in terms of, a company response, performance obligations have been a frequent topic that we've seen in the comment letters to date. There was actually a report from a firm named Intelligize in November, and they did a study on early adopters, and in that they said that 69% of the comments done on early adopters were effectively, by the SEC, were centering on performance obligation measurement and definition. And so in this particular case, I think it's interesting because the comment drills into that area, and I think the company's response is a narration of what the commercial spare parts contracts entail, what the performance obligations entail, and then how they come up with how they allocate and handle returns, et cetera. And so it was interesting in terms of the response, and and I think they started out right away, Matt, with a reference to the fact that our commercial spare parts have discrete unit prices that can be used as standalone fair values, which goes to, whether you want to quibble with the terminology or not, but effectively they're coming out of the gate saying each piece has a standalone selling price that we can go to, and then it starts to talk about how the customers order them. But, I think the answer packages it up nicely with how the guidance would require it, but it's interesting that the SEC drilled into this area and then also asked, about whether it's optional or not. Is this something you've dealt with, Matt, when you work with companies in the field in terms of, their questions about, we have different types of contracts for different product lines. Do we have to treat them differently or not? And then, them expounding on that to the appropriate level of detail like this company did here.
Yes, this is something that I've dealt with. Actually, very specific example dealing with specific spare parts. And I think what's important here is when you tell this story and you just think about process flow, usually spare parts are something that's optional in a contract that you do buy separately. So it's important to clearly define what your performance obligations are that are in the initial contract versus what is going to be optional. My inclination when I read the disclosure was that it was optional. It was hard to tell the difference. So it's important to get into the details and figure out what truly are the performance obligations versus what is an option, and whether or not that option may, for example, have a material right because of a significant discount being offered.
Agreed. And I think to kind of piggyback on that, Matt, boiling it up in terms of, or bringing it up to a higher level, I think when I read this, one of the things that struck me, and it was an article I read recently as well, is that the aim of many of the comment letters is to, the term clarify or clarification is a recurring theme, is that it's not as if the company in its original filing didn't speak to something, they just didn't clarify what that was. And to your point, in this case, there are a number of areas the company clarified in their response that helped. If it had been, obviously hindsight's 20/20, but if it had been in the original filing, they wouldn't have got the comment letter. But it's pretty instructive in their response to the SEC, and the clarification was really, in my mind, the central theme of that response. Excuse me. Okay.
Yes, I agree.
All right. Let's take a look at number 7. So this one, I think, some personal interest in, just because we are a company that provides automated solutions, software, upgrades, etc. And so, obviously, speaking personally, I have an interest, but also, I think it would have macro applicability because of, just the prevalence, and especially whether your company provides an offering that requires updates or upgrades, or whether you're a consumer, which we almost all of us are, with the handheld devices we have and the various devices we have in our lives, our homes, etc. This comment gets to the heart of that, and so it asks, for your devices, systems, and system integration solutions, please tell us the extent to which your contracts with customers include an obligation to provide updates to the software embedded in your hardware products. If applicable, please describe for us the terms associated with your obligation to provide updates, and tell us how you consider the impact of this obligation on your allocation of transaction price and timing of revenue recognition. So, it's a fairly, there's a good amount in that question, and the company's response in this, it has a number of key points. I think, in this case, the company's response, at the risk, and I'll read some of it in a moment, but effectively it hits on major areas in terms of what constitutes in their mind their performance obligations, whether the revenue is recognized at a point in time versus over time, how standalone selling price is determined, and then how revenue is allocated to the performance obligation. So all of those topics are covered, and they stratify it by unspecified software updates versus specified software updates. So if we read the first portion here, it says services that grant customers the right to unspecified software updates. And so the key, and this is my comment, the key is the next part, on an as-available basis represent a single performance obligation recognized over time on a straight line basis as the series of services are transferred. Then if the services are bundled with devices or system integration solutions, the contract transaction price is allocated to the performance obligation on a relative standalone selling price basis as prescribed by 606-1032-29, and then it indicates we estimate standalone selling price for the company's unspecified software updates based on analysis of observable sales transactions. So, fair amount to unpack, but I think the second part talks about, okay, how do we handle the specified software updates? And so, and going back to my original comment, we all have devices, or we all likely use, technology where they're, whether we know it or not, we are recipients of unspecified updates or specified updates. And it's interesting that this particular company was a subject to a question regarding that. And you can see that the type of update will affect a number of factors with respect to, is it recognized, especially is it recognized over time or at a point in time? And so, Matt, when you've dealt with companies, has this question come up quite a bit? And then I know there are other factors to consider in terms of how companies would delineate between an unspecified software update and a specified software update, and how that would translate into revenue recognition. Do you have any thoughts on those areas based on your experiences?
Yes, I mean, the difference in accounting is significant between an unspecified software update versus a specified software update, moving from a straight line basis to a point in time basis for the specified software update. But the the devil's in the details, so to speak, because there's a gray area on what really qualifies as let's call it a specified software update. So if a company is moving from, let's say, 1.0 to 2.0, and then they disclose that either in a press release or in a contract or on a roadmap that they give to their customers, then that's pretty clearly going to be a specified software update. However, if a company says, okay, in a few months, we're going to add these features and functionalities to a product, is that just an unspecified software update, or does it meet the definition of a specified software update? It's not always clear, and I would really encourage companies to work with their auditors to make sure that there's strong documentation over why that, let's call it disclosure, would drop the performance obligation into an unspecified bucket versus a specified bucket. So said another way, if company is disclosing anything about future products and functionality, whether it be the different versions or the latest functionality that's going to come out, companies should take a step back and have clear documentation in their adoption memo around which bucket those potential performance obligations will go under. And this is an area where even under 605, we saw a lot of errors. So I would encourage companies now under 606 to take a good look at it and make sure that they've documented it correctly.
Thank you, Matt. In addition to that, and those all hit on points that I obviously key. What I would say as well, Matt, just extending what you're saying, is that, and we've seen it when we've been in the room with teams during their implementations of our solution, that this is the type of scenario where teams that are implementing 606 realize that they need more than just the finance and accounting team in the room to understand their business and then to make the right decisions going forward. And so that in terms of how how they market and how they create the roadmap for their products and services would impact the accounting down the line, because this is something that when we've seen initial discussions, folks don't think that would have be applicable to what they're talking about. But then this type of topic comes up, and the number of people in the room on the implementation project of 606 increases just because they have to bring these type of considerations to bear, or else, to your point, the accounting is treated quite differently depending upon which route they go down. So that's what we've seen in many cases.
Yeah, I think those are really, really applicable points to this. And I would just, again, encourage everyone to spend some time focused on this area if it's applicable to your company within the tech sector.
Thank you. All right, it's time for our last poll before our last example. So we're in the home stretch here. So let's talk about our last question. And so I'm going to launch that. And our last question is, did ASC 606 lead to a change in the timing of revenue recognition for your company's contracts with customers? And so 3 potential answers here. We probably could have come up with quite a few, but we tried to limit it. I'll give folks another 10 seconds, and then we'll take a look at the results. Okay. Close that up. Let's share the results here. So, looks like, interesting. So, it looks like, in many cases, it did not change the timing. Obviously, so it's across the board. There wasn't, I don't think, my read on this is there wasn't a, tectonic shift, but, and obviously it depends on, business models, industries, what have you, but it's interesting that, out of the 2, the change went to more overtime recognition. Does that correlate, Matt, with your experiences and when you've talked to people, or has it really been dependent on other factors, depending upon industry, vertical, their contract structures, et cetera?
Yes, this is really interesting because the way 606 reads is that it almost has an expectation that you're overtime, and only if you fail overtime do you go to point in time. So it doesn't surprise me that there's quite a few companies that have reached the conclusion that they're going to be overtime. The point in time rev rec is a lot of times related to term licenses, as term licenses at least within the software industry will typically result in upfront revenue recognition. The last one is the one that I really wanted to focus on, though, which is it did not have any impact. But it'd be interesting to know it did not have any impact, but how much time had to be spent documenting 606 in order to come full circle to the same accounting conclusion. And we're definitely seeing that on a number of our companies. Sometimes it takes just as long to come back to that same conclusion as it would be to come up with a different conclusion for the accounting. So it's really, this to me is one of the most interesting poll results we've seen here today.
Thank you, Matt. Yeah, that's a great point in that, it goes back to the, earlier in the hour in that, there may have been no change, but to your point, just to get back to the place that you started, you have to go through what can be a pretty lengthy exercise, a series of exercises to get there. And so it's a great point. All right, I will tie that up. Let's go to our last example here, and this one has the biggest footprint, but I think it provides a lot of value. I know, Matt, when we were prepping for this, we felt this both in terms of frequency, we see it, and both in the value that this example and the company's response brings. It's something worth going over. So I think the comment letter base, short and sweet, it says you indicate that the selling price of your software licenses is highly variable, and therefore you estimate the standalone selling price using the residual method. Please provide a comprehensive quantitative discussion of such variability to support your conclusion. So, in this case, and if I just click through, and I'll go back, I don't want to make people's eyes go too crazy, but you can just see if we just click through here, I've got 3 slides worth of input the company provides in response to that comment. And so there's a lot of activity here, whether, and I use the cliche, what is it lead to productivity? We'll see. But, effectively, I'll read off parts of it, but the company starts out by indicating, starting out that, what is the definition of the residual approach? So though many of you on the phone may know it, but just for those in case you don't, so the second bullet here is under 606.10.32.34c, an entity may use the residual approach to estimate the standalone selling price by referencing the total transaction price less the sum of the observable standalone selling prices of other goods or services promised in the contract. So stated another way is, at least one of the items in the contract has to have an observable standalone selling price, and then for any items that do not have that, the residual approach could be utilized. And the guidance, the response to the comment here, it just goes through, what the company's process was in terms of reviewing its pricing practices, how it, effectively achieves standalone selling prices for other performance obligations. I think what's important, and Matt, I'll let you speak to us in a moment, is they also talk about the guidance referenced methods in terms of the adjusted market assessment approach and cost plus margin approaches. They're indicating that they vetted those to see if for the products where they use the residual approach, either of those, let's say it on the hierarchy, either of those two approaches that sit above residual could be used. And they're saying, no, and that, based on factors such as, insufficient data on market factors, competitor pricing information for similar licenses, cost information, what have you. I think as they progress through it, they start to talk about other factors such as, how they stratify their customers in terms of, type, size, geography, what have you, how they configure, whether there's a certain number of customization or configurability, and then the term of license. So you can start to see there's a lot of information here that all leads up to the last point they make. And this is a key point, Matt, that you brought up when we were preparing, is that they have to get to the point where they're stating, and I quote, as a result, the company concluded that the residual approach was the most appropriate method given the high variability of selling prices, and that a representative standalone selling price is not discernible from past transactions or other observable evidence. And so that leads us to this last slide, which was part of the company's response, which effectively is an attempt to an extent, quantify all of the factors that they put forward. And so, Matt, I think the first point here, from my standpoint, is they provided a lot of information as to whether it gets to adequately or clearly expressing what we would call the compliance rate, or what they use to make that decision on high variability. From a SOFTRAX standpoint, or my standpoint, that could be in question, but there's no doubt that the company's response was robust. What's your view on the question and then the resulting response, and just the topic as a whole in terms of the residual approach?
Yeah, I mean, this last example, I mean, there's a lot here, right? And as I was mentioning, before we got on this call, we could spend an hour just talking about this comment and the response. Here's what I would say about it. A couple things. So the residual method should only be used on an exception basis. It's going to have to, there needs to be significant and rigorous support to get to the conclusion that it truly is highly variable and that you should be applying the residual method. I think sometimes what we get in the habit of is just by nature of a company, the reason you're in business is typically because you provide a product that is kind of an exception or a differentiator in the market. But the place you never want to be an exception at is when it comes to accounting. So if we're going through this exercise of adopting ASC 606, and there seems to be this conclusion that is the exception basis, what I would encourage companies to do is take a step back and look at how the data is being accumulated. Because a lot of times, and this has been my experience, is the data was being accumulated in a manner that didn't lead towards a conclusion other than the residual approach. So here's what I mean by this. So companies may have been mixing, for example, government contracts and non-government contracts together. And they said, okay, it's highly variable because the pricing's all over the place. Well, no, it wasn't really all over the place. It's that you combine those two. What we need to do is stratify those two, and then all of a sudden the pricing isn't highly variable. So really take a step back and look at how the pricing or how the data is being accumulated. Another way that the data could be stratified could be by country code, or it could be based on volumes, similar to what we have here. In terms of the compliance percent, I get asked this question a lot of times. I would say that if you're over 60% compliance, so plus or minus 20% of your transactions are within, if 60% of your transactions are within plus or minus 20% of a midpoint, then you're probably in pretty good shape. But that being said, work with your auditors, figure out what that compliance rate looks like, and more importantly, figure out what it's going to look like over time, not just historically, because directionally that's important in being able to explain to the auditors, for example, why your product is not highly variable and would lead to the residual method, right? So there's really a lot in this example. I'd encourage everyone to read it offline and maybe even listen in to the recording of this webinar again, because if the company is going down that direction, it's going to be an exception, and you won't find a huge number of companies out there that will allow for benchmarking of disclosures.
Matt, thank you. It's a great answer. We're just about at the end of our hour, so I just wanted to first thank all of you for attending, and Matt, thank you for participating and providing all, just the level of detail and real world experiences that you did. And then just note that for the attendees, we have webinars, 2 coming up in January and 1 in February, all of which you can sign up for on our website, SOFTRAX.com or RevenueRecognition.com. And then additionally, there's a handout with this deck available through the GoToWebinar console, and you can download that. Any questions that came in today, we will address following this session, and then certainly contact Matt or contact me with any questions directly that you think of following the session. Again, we thank you for your time today. Have a happy holiday season, and look forward to talking to you soon. Goodbye.